Let's try and get a better sense from B. Prasanna, the Group Head of Global Markets, ICICI Bank, joining us on the show. Hi, Prasanna. Good to be speaking with you. Well, what do you make of it? 90 on the rupee, possible in the next 6-8 months?
No, Anisha, I don't think 90 is a possibility. But of course, you can never say never in markets. It's quite, I mean, there is a probabilistic scenario in which it could be possible. But our house view is not of 90 happening anytime soon. We do feel that what's happening over the last 1 month or so is a kind of a catch-up depreciation that's happening on the INR. If you really see in the last quarter, the dollar index has appreciated close to 8%, but the INR kind of depreciated only by 2.1%. Whereas in the last month, the dollar index has appreciated by 1%, whereas the INR is depreciated by slightly more than that. So I would say that it's kind of a catch-up depreciation of what did not happen in the first 3 months ever since the Trump trade started.
Right. Prasanna, the other thing, of course, is, and we've been chatting about this consistently as well. What can the RBI do? What tools do they have at their hands, and whether that'll really work or not?
So I think the rupee has been held a little too strong on a relative basis. If you look at the INR against most of the other currencies, it has appreciated because the other currencies have all depreciated much more against the dollar. So what we are really seeing is the dollar strength which is going on. So I think to some extent, I think there has been a change in the way RBI is approaching it in the last 1 month or so. And I would say that this depreciation of the INR is a part of that strategy. I think RBI should do more of that. If the dollar is appreciating because of a global force, then I think they should kind of let it depreciate a little. Yes, they might want to come in and stymie a little bit of a volatility, but then if there is a trend depreciation, they should let the rupee depreciate. That's one. Second thing is, I think they have sucked out a lot of liquidity from the banking system on account of all this intervention that they have done over the last 3-4 months. I think the loss of liquidity is almost to the close of 4 lakh crores over the last 3-4 months. So I think they did do the CRR cut, which gave around 1.2 lakh crores to the system. I think they need to do more of that. They need to do more of liquidity infusion, and they have a couple of tools available at their disposal. They're already started to do a lot of buy-sell swaps in the forex market. They should continue with that to the extent it's possible. To the extent the market is liquid, they can do that. They should also maybe explore about another CRR cut to the extent that it gives you more liquidity into the banking system. And at some time also think about open market purchases of bonds to give in liquidity. So let the rupee depreciate, give more liquidity in INR terms, and also consider a rate cut in the February policy. In their wisdom, of course, they will decide whether it is appropriate or not. But the fact that growth has slowed down, and the only thing, if at all, that is possibly going against a rate cut is this strength of the dollar and the weakness in the INR. But if you were to convince yourself that the strength of the dollar is more like a global phenomena, and the INR is not depreciating on account of any weakness in CAD per se, current account deficit is still pretty okay, then I think a case can be made for a rate cut to support growth. So I guess let the rupee depreciate, give more liquidity, and cut rates is the prognosis that the Reserve Bank could possibly be doing.
Let the rupee depreciate, rate cut, that's the prognosis that you have at this point of time, Prasanna. But, the rupee depreciation will have larger implications and not just, export-import in the sense of fiscal deficit and trade deficit and whatnot. Do you think all of that would be okay if we continue depreciating, or that could raise, red flags or concerns at the macro level as well?
No, I mean, if at all there is a macro concern that can arise out of a depreciating rupee, it would be more from an inflation perspective as to whether a depreciating INR is importing inflation from the rest of the world into India. But from that perspective, thankfully, we have a core inflation which is really going down, WPI which is much lesser, and we have Chinese goods, into the global markets, which is at much lower prices, and hence there seems to be no fear of an impending rise in inflation. And on top of it, you also have oil price increase not really passing on to the Indian inflation because of the pump prices being kind of having still a cushion. So yes, there will be a 15-20 basis point impact of a 5% depreciation of the INR on inflation, but I don't think that is something that we need to worry about from a macro perspective. As far as I don't think it really affects fiscal. it might actually make, if the rupee depreciates, it might actually make the current account deficit a little bit better on account of the export competitiveness for some of the goods. But also bear in mind, capital flows are as important. And when you have a very overvalued INR, which it was maybe a month ago before the current bout of depreciation happened, capital flows were not coming in, and instead it was actually going out. And people were selling equity and then taking money out. Of course, the selling equity is a different phenomena. It's a function of different set of parameters. But at least on the currency side, if we can reduce our overvaluation, then that reduces the incentive for people to take out money in dollar terms. So I think that's what has happened over the last 1 month or so, where the rupee has depreciated.
Right, Prasanna, great to have you on the show. Thank you so much for your time.
If you like this video, then like, share and subscribe to ET Now.